greatest danger for the breakout trader is the illusion of momentum, often leading to premature entries that quickly reverse and stop out the unwary speculator. Buying the initial surge above resistance is a high-risk gamble because institutional players frequently use these levels to trap eager retail traders, initiating a move that lacks genuine professional sponsorship. Richard Wyckoff's methodology provides the definitive solution to this recurring problem by teaching us to ignore the initial noise and wait for the conclusive evidence of institutional commitment. This evidence is known throughout the Wyckoff community as the sign of strength, which acts as the market's formal declaration that the accumulation phase is completed and a genuine markup is now beginning. The sign of strength transforms the act of trading breakouts from a low-probability, high-stress endeavor into a calculated, high-probability entry based on verifiable institutional intent and supply absorption. Before we dive into the precise mechanics of identifying this powerful market signal, please take a moment to subscribe to the channel and leave a quick comment below. Even just a single word or a simple thank you greatly assists the algorithm in recommending this essential trading knowledge to more people who need it. Your simple action shows me that this kind of detailed educational content truly matters and is worth the extensive time and effort required for its creation. Please also remember to return to this channel whenever trading becomes difficult or your confidence starts to waver, as our goal is to provide reliable foundational knowledge to support your journey. We are here to help you build consistency, not just chase fleeting profits, so hit that subscribe button now and let us continue this crucial lesson on market structure. The central problem that plagues most novice and intermediate traders is the relentless failure of initial breakout attempts, often resulting in repeated losses and a crippling erosion of trading capital. These deceptive movements are often referred to as false moves or specific Wyckoff maneuvers like a spring that fails to follow through, or an upthrust that quickly collapses back into the prior trading range. Traders see the price cross a well-defined resistance level, and fearing they will miss the move, they rush in only to be immediately caught as supply re-emerges and crushes the rally. Wyckoff recognized that the true power lay not in the initial crossing of the resistance line, but in the specific quality of the subsequent price and volume action which confirms the institutional hand. He taught that without this critical confirmation, any move above a major resistance level should be treated with extreme skepticism and caution, regardless of how dramatic the initial candle appears. The sign of strength, therefore, is not just another technical indicator. It is the definitive confirmation required to validate that accumulation is genuinely complete and that the large operators are truly ready to commence the sustained upward trajectory. Wyckoff insisted that retail traders must learn to see the market through the eyes of the professional operator, understanding that these large players accumulate positions patiently, often shaking out weak hands right before the major advance begins. The sign of strength serves as the market's loud and clear announcement that the long, tedious process of supply absorption has finally finished, and that the path of least resistance is now definitively higher. This signal provides the high-probability entry point that allows the disciplined trader to participate in the markup phase, minimizing the risk associated with buying into volatile, unconfirmed initial movements. By waiting for the market to prove its intent through the sign of strength, traders avoid the emotionally driven chase and instead enter the market at a point of structural advantage. This strategic patience is the cornerstone of Wyckoff's approach, fundamentally shifting the trader's focus from chasing action to confirming institutional intent before committing capital. The thesis underlying this entire guide is simple yet profound. The sign of strength transforms breakout trading from a high-risk gamble into a high-probability entry rooted firmly in the observable evidence of institutional sponsorship. It ensures that when you finally commit capital, you are not betting against the large operators but rather moving alongside them, benefiting from their powerful commitment. Understanding the sign of strength requires a deep appreciation for the underlying market structure, particularly how supply and demand dynamics shift as the trading range transitions into a sustained trend. This specific technical pattern removes the ambiguity surrounding conventional breakouts, providing a clear, objective checklist that must be satisfied before any long position is initiated. By mastering the characteristics of a true sign of strength, you gain an invaluable edge, allowing you to filter out the noise and focus solely on those movements that possess the necessary institutional conviction to sustain a significant advance. We must first establish a clear distinction between the generic breakout failure and the genuine confirmed strength that Wyckoff sought in the market. A generic breakout failure occurs when the price moves above a known resistance level, often on high volume, only to quickly reverse and trade back below that resistance line, trapping the late buyers. This pattern frequently indicates that the move lacked professional sponsorship, or that the overhead supply was simply too overwhelming for the initial burst of demand to overcome effectively. The reversal demonstrates that the effort put into pushing the price higher did not yield the sustained result expected, a critical concept in Wyckoff analysis. Such failed moves are typically designed to lure in retail interest, providing the large operators with liquidity to distribute their remaining inventory or to initiate short positions against the unsuspecting crowd. Wyckoff's concept of effort versus result is the foundational tool used to differentiate these weak moves from true strength. Effort is measured primarily by volume, while result is measured by the corresponding price spread or the movement of the price bar itself. When we see high volume, high effort, but the price bar shows only a narrow range or fails to close significantly higher, this suggests that the demand is meeting heavy supply, meaning the effort is resulting in little upward progress. Conversely, when high volume, high effort results in a wide price spread and a strong close near the high of the bar, this is a clear indication that demand is dominating supply and that the professional operators are actively involved in driving the price higher. This crucial comparison allows the trader to assess the health and conviction behind any movement, especially those initial attempts to break free from the established trading range. The movement immediately preceding the sign of strength is often the jumping across the creek, or JAC, which signals the overcoming of resistance. The creek is Wyckoff's term for the resistance line that defines the upper boundary of the accumulation trading range, representing the last major hurdle that supply must be fully absorbed before the markup can begin. A successful jumping across the creek is characterized by the price decisively closing above this resistance, demonstrating that the market has sufficient momentum to transition out of the base. However, the jumping across the creek itself is not necessarily the low-risk entry point, as it can still be quickly reversed if the subsequent testing reveals lingering supply. It is the action after this jump, specifically the sign of strength, that provides the necessary confirmation that the overcoming of resistance is permanent and not merely a temporary overshoot. Understanding the difference between a minor rally and the definitive sign of strength is paramount for successful Wyckoff trading. Minor rallies within the trading range, even those that cross the creek, often occur on inconsistent volume and lack the sustained follow-through necessary to confirm institutional commitment. The sign of strength, by contrast, is a powerful, unmistakable surge that occurs only after the market has spent sufficient time preparing for the markup, proving that the supply available at the old resistance level has been completely exhausted. Therefore, the trader must train their eye to see beyond the surface price movement and analyze the underlying force, the volume, to determine if the resulting price action genuinely signals a change in market character. This analytical rigor prevents the impulsive buying that leads to losses on failed breakouts and enforces the discipline of waiting for true market conviction. The sign of strength is not merely a large green candle, it is a highly specific structural event that requires mandatory volume and price spread confirmation to be considered valid under the Wyckoff method. By definition, the sign of strength is a strong, decisive move that breaks out of the accumulation trading range, often occurring after the successful completion of the critical testing phase, Phase C. This move must demonstrate undeniable market power, leaving no reasonable doubt that the institutional players have taken full control and are aggressively bidding prices higher. It represents the first truly significant and sustained commitment of demand that the market has seen since the selling climax established the initial low of the accumulation structure. This decisive quality ensures that the move is fundamentally different from the weaker, earlier rallies that were easily contained by a profit-taking and lingering supply within the base. The mandatory volume confirmation is arguably the most critical component of a true sign of strength. The volume accompanying this move must be significantly higher than the average volume observed within the preceding accumulation trading range, often spiking dramatically above the typical daily or weekly average. High volume confirms that the move is backed by professional participation, indicating that large amounts of capital are being deployed to overcome any remaining resistance and propel the price upward. If a move above the resistance level occurs on merely average or decreasing volume, it must be dismissed as a suspicious or weak move lacking the necessary institutional fuel to maintain its trajectory. This volume signature is the trader's clearest evidence that the effort being exerted by demand is overwhelming the available supply, ensuring the sustainability of the breakout. In conjunction with high volume, the sign of strength must also display wide price spread confirmation. A wide price spread means that the candle or bar representing the sign of strength is long and robust, demonstrating that price traveled a significant distance from its opening to its closing level. This wide spread shows that the lack of overhead supply was sufficient to halt the upward progress, allowing demand to push the price aggressively higher without meeting significant resistance. If the volume is high but the price spread is narrow, it signals the effort versus result discrepancy we previously discussed, indicating that supply is still present and actively absorbing the demand, which invalidates the potential sign of strength. Therefore, the perfect sign of strength is a powerful combination. High volume driving a wide price spread, culminating in a strong close near the high of the bar, leaving a distinct visual signature of conviction on the chart. The technical location of the sign of strength is also part of its anatomy, as it must originate from a position of relative strength, typically following a successful test of support. The move must clearly demonstrate a shift in the character of the market, moving away from the choppy back-and-forth action of the accumulation base and into a clear directional bias. This movement is the final step in proving the base is ready, confirming that all the necessary supply absorption maneuvers have been successfully executed by the professional traders. By dissecting the sign of strength using these three components, decisive price action, mandatory high volume, and confirming wide spread, traders can objectively confirm the market's readiness for the markup. This rigorous analysis prevents the costly mistake of treating every volatility spike near resistance as a true breakout opportunity, thereby protecting capital and maintaining trading discipline. To properly utilize the sign of strength, the trader must understand its precise location and context within the larger five-phase structure of the Wyckoff Accumulation Schematic. The context is crucial because a move that looks like a sign of strength in isolation might simply be a secondary test or a minor rally if it occurs too early in the cycle. The sign of strength does not occur until the market has established a solid base of support and has successfully weathered the initial selling pressure that defined the start of the accumulation. This baseline is typically established after the selling climax, which marks the low, and the subsequent automatic rally, which establishes the initial high of the trading range. Therefore, the SOS is not found in the chaotic early stages defined by panic selling and initial rebound attempts. In the context of Phase B, the sign of strength must be differentiated from minor rallies that occur while the market is still absorbing supply. Phase B is characterized by the market settling into a trading range where supply and demand are relatively balanced, with institutions slowly and methodically accumulating shares. Rallies during Phase B often fail to sustain momentum and usually occur on volume that is high but not decisively overwhelming, demonstrating that the market is still undergoing internal supply absorption. The true sign of strength, by contrast, is a Phase D event, occurring only after the market has successfully navigated the complexities of Phases A, B, and C, ensuring that the supply absorption process is truly complete. Recognizing this temporal difference is key to avoiding premature entries that are prone to failure within the supply-heavy environment of Phase B. The successful completion of Phase C often acts as the immediate precursor to the sign of strength, providing a crucial contextual confirmation. Phase C is the testing phase, where the market executes a critical maneuver like a spring or a test, designed to shake out the final weak holders and check for remaining overhead supply. If this test is successful, meaning it occurs on low volume and fails to break below the accumulation structure, it validates the market's preparation for launch. The sign of strength then emerges as the powerful reaction following this successful test, confirming that the market has now been cleared of residual supply and is ready to move into the mock-up phase. Without a successful Phase C test preceding it, a move resembling a sign of strength should be viewed with extreme suspicion, as the necessary preparatory work may not have been completed. The sign of strength is the first clear evidence in Phase D that demand is decisively in control and is actively moving the price towards and beyond the high of the trading range. Phase D is defined by the transition from the accumulation base into the markup, with the price action showing a consistent pattern of higher highs and higher lows. The sign of strength, along with subsequent movements like the last point of support, confirms that the underlying market character has shifted from sideways consolidation to determined upward movement. It serves as the institutional signal that the risk of the trade has fundamentally changed, moving from the high-risk environment of the consolidation base to the significantly lower risk environment of a confirmed trend initiation. By placing the sign of strength correctly within this schematic, traders gain the necessary structural perspective to understand the market's true intentions and timing. The primary reason traders continue to lose money on breakouts is their impatience, characterized by buying the initial volatile move above the resistance level, which is often done without any confirmation. Richard Wyckoff's methodology powerfully addresses this by teaching the disciplined trader to wait not for the sign of strength itself, but for the reaction after the sign of strength, providing a low-risk, high-probability entry. The sign of strength is the confirmation of intent, but the reaction that follows is the opportunity for a safe entry, allowing the trader to place a tight stop loss with a strong structural backing. This approach removes the emotional pressure of chasing momentum and replaces it with a calm, methodical execution based on proven market behavior. The critical difference between losing and winning breakout trades lies in identifying the last point of support, or LPS, which is the essential low-risk entry point. The last point of support is the pullback that occurs immediately following the powerful sign of strength, where the market returns to test the level of the creek that was just successfully overcome. This pullback is a natural and necessary function of the market, allowing institutions to confirm the structural integrity of the breakout and provide a final opportunity for patient traders to join the move. It is crucial to understand that the old resistance level, once broken by the sign of strength, must now successfully act as confirmed support during this pullback, validating the shift in market polarity. There are 3 mandatory confirmation criteria that must be satisfied at the last point of support to validate it as a safe entry. First, the pullback must occur on decreased volume, which is the most important signal of supply exhaustion. Decreased volume during the pullback confirms that the selling pressure is minimal and that professional operators are not distributing their newly acquired positions, but are instead holding firm. If the pullback occurs on increasing or high volume, it signals potential renewed supply, which would invalidate the last point of support and suggest that the sign of strength was actually an upthrust failure. Second, the price spread during the pullback must narrow significantly, indicating minimal selling pressure even among those few sellers who remain. Narrowing price spread reinforces the low volume signal, visually demonstrating that sellers lack the conviction and power to drive the price significantly lower. A pullback that displays wide price spreads, even on moderate volume, suggests strong selling interest that could threaten the structural integrity of the newly established support level, forcing the trader to remain on the sidelines. The combination of low volume and narrow spread provides powerful evidence that the market is simply pausing to consolidate before the next leg of the markup begins. Third and finally, the price must hold firmly above the previous resistance level, the creek, which now acts as the confirmed support. The last point of support confirms the conversion of resistance into support, a fundamental principle of technical analysis, but validated here by Wyckoff's volume criteria. entering a long position at the last point of support. Once these three criteria are met, allows the trader to place a protective stop just below this confirmed support level, defining the maximum risk with high precision. This patient waiting for the test and confirmation is the single most effective way to eliminate the losses commonly associated with impulsive buying on initial breakouts. Once the sign of strength has occurred and the subsequent last point of support has been successfully identified and confirmed by low volume and narrow spread, the practical aspects of trade management take precedence. Setting the stop loss correctly is paramount to protecting capital and must be done immediately upon entry at the last point of support. Traders should place their stop safely below the confirmed last point of support, ensuring that the stop is positioned below the structure of the creek that was just successfully overcome. This placement ensures that if the market unexpectedly reverses and breaks back below the resistance turned support, the trade is quickly exited with minimal loss, confirming that the initial sign of strength was ultimately a false signal. The stop loss should not be placed so tightly that it is susceptible to normal market fluctuations or minor shakeouts, but it must be placed at a level that definitively invalidates the accumulation structure. If the price returns to the accumulation trading range after the sign of strength and the last point of support, the professional intent has failed, and the trade must be abandoned immediately. By using the structural context of the creek and the last point of support, the stop placement becomes a logical, objective decision rather than an arbitrary distance from the entry price. This systematic approach to risk management ensures that the trade opportunity justifies the risk taken at the low-risk entry point defined by the last point of support. Targeting the markup phase is the next crucial step, and Wyckoff provided a robust method for projecting minimum price objectives using his point-and-figure counting technique. The point-and-figure count, which measures the horizontal extent of the accumulation trading range, provides a quantitative estimate of the potential upward movement that the institutional accumulation should fuel. This projection is essential because it ensures that the potential reward significantly outweighs the risk defined by the stop loss placed at the last point of support, satisfying the necessary risk-reward criteria for a professional trade. Traders should use the minimum count projection as a guide, understanding that the market may exceed this target if conditions remain favorable and the trend is strong. Throughout the markup phase, the principle of effort and result must be continuously monitored to confirm that demand continues to dominate supply and maintain the upward trajectory. Subsequent rallies following the sign of strength should continue to show wide price spreads on high volume, indicating sustained professional interest and a healthy trend. If, however, the market begins to show signs of high volume but narrow price spreads during the advance, this signals that supply is beginning to re-emerge, potentially indicating institutional distribution or a slowing of momentum. Recognizing this shift in effort versus result is critical for managing the trade. Allowing the trader to tighten stops or take partial profits before a significant reversal occurs. The sign of strength is the gateway to the markup, but the last point of support is the precise, low-risk doorway, providing the necessary confirmation and structural support for a successful trade. By adopting Wyckoff's complete guide, waiting for the SOS, confirming the LPS, and managing the trade using effort versus result, traders can dramatically improve their success rate and stop losing money on unpredictable initial breakouts. This disciplined methodology focuses on institutional intent, volume confirmation, and structural integrity, providing a comprehensive framework for navigating the transition from consolidation to trend. Mastering this sequence ensures that capital is deployed only when the market has provided overwhelming evidence that the path of least resistance has been definitively established by the large informed operators. This detailed understanding of market structure, volume analysis, and timing is what separates the consistently profitable traders from those who struggle to find an edge. If you are serious about transforming your trading and moving beyond the inconsistent results of conventional technical analysis, then deepening your knowledge of Wyckoff's original work is the logical next step. Richard Wyckoff himself formalized these precise techniques for identifying institutional intent and projecting market movements in his essential texts. we highly recommend reviewing the adapted edition of his classic work, How I Trade and Invest in Stocks and Bonds, which provides timeless methods for analyzing the market and determining the intentions of major players. This book serves as an invaluable resource breaking down Wyckoff's tested methods for supply and demand analysis, helping you define high-probability trades with greater clarity than ever before. To access this foundational text and integrate Wyckoff's complete framework into your daily analysis, please find the link in the description below and secure your copy today. The commitment to structural analysis confirmed by volume is the ultimate defense against the market's traps, and the sign of strength is the ultimate confirmation signal. Use this knowledge to trade with patience, precision, and confidence, knowing that you are waiting for the market to prove its intentions before you commit your capital. The wait for the sign of strength and the subsequent last point of support defines the professional approach, ensuring that your entries are always backed by the power of institutional demand. We encourage you to review the charts using these principles, focusing on identifying clear signs of strength, followed by confirmed last points of support to solidify this powerful methodology.